Hello and welcome to interest.co.nz. I'm Gareth Vaughan and I'm here with another one of our double shot interviews. I'm joined by Roger J. Kerr, who is a partner at PwC and specialist in treasury advice. Thanks for joining us, Roger.
Pleasure.
Great timing too, obviously, because we've had the Federal Reserve this morning, the FOMC meeting, outcome of that, and we've had New Zealand GDP figures out, so there's been a lot going on. So if we jump into the Fed first, now markets have got all excited about the Fed tapering off its quantitative easing program. It's $85 billion worth of bonds it's been buying a month.
Yep.
New Zealand dollars come back against the US dollar as a result of this. What's your take on all of this?
Well, I actually thought ahead of this, the Fed meeting this morning, I thought Bernanke would take the opportunity maybe to hose down some of the heightened expectations the markets have had in recent weeks, that they would taper off and it would be quite soon and they'd reduce the stimulus, as you say. And in fact, he didn't do that, so he didn't hose down. So we thought there was a chance of the US dollar actually weakening on Bernanke hosing down the expectations, but he didn't do that. So the US dollar has strengthened, and in particular, which is not surprising, the bond yields are up. So US 10-year Treasury bonds up to 2.38%, and we're not surprised at that. I mean, we've been expecting long-term interest rates in the US to rise for some time, and really what came out with this morning, I mean, in terms of the US economy and their reading of the US economy, what they're saying is the risks are less of it falling back down. So, and he's obviously set out a whole lot of conditions of when they might take their foot off the accelerator. But I think what Bernanke made very clear, and this is the market's got to understand this, that they're not tightening policy now. I mean, tightening monetary policy is putting your foot on the brake. All he's doing is taking his foot off the accelerator, as he said in the press conference, a little bit. But giving guidance and transparency, to the markets of potentially the likely timing, mid-2014. But as always, dependent on the data. So US economic numbers have got to remain positive, which we think they will, because at a household level in the US, things are going really well now. Jobs, retail, housing.
Yeah, but obviously, as you point out, I mean, it's quite conditional.
Yep.
Even the tapering. I mean, for example, the Fed's got their unemployment target. They want to get that down to 6.5%. It's what, 7.6%?
Yes, correct.
At the moment. So, I mean, there still could be things that happen or don't happen.
Absolutely.
To perhaps slow the pace of tapering. I'm just wondering whether you think the markets are getting a little bit ahead of themselves, maybe.
Yeah, I thought they were a little bit, but typical. The US bond market and the foreign exchange markets, they're always pricing the future in a long way in advance. So what they're pricing today is what's going to happen in 2014, 2015, and particularly in foreign exchange markets. So maybe I think the numbers in the US economy have been good, and in particular, I think the big thing that's not reported a lot in the US, because. You say, well, inflation's very, very low. Why would they be changing anything? And the reason inflation is low is the revolution in shale gas and the cost of energy. And that not too many people pick that or have seen that. And US businesses are competitive because their energy costs have gone down massively. And that's, I think, the US. It's a real positive, factor for the US economy.
What sort of scale? I mean, you talk about massive reductions.
Well, if you have a look at a chart of natural gas prices in the US, I mean, I can't remember the exact numbers, but it's down, 30-40%.
Over how long?
Oh, in the last couple of years.
Okay.
Decreases in energy costs. So that's real positive for the US economy, for their competitiveness. And it's certainly one thing that's keeping inflation down now in the US. But so that sort of underpins a little bit in terms of some of the jobs growth. And so the risks of a falter or a hiccup in the US economy, I see is just a lot less than what it has been. And particularly because, as I said earlier, I mean, at a household level, there's more confidence, which is, at the end of the day, economies go on consumer spending, and that's looking better, which is a dramatic contrast to Europe, where it's the opposite.
Yeah, another story altogether.
Yeah, exactly.
Now, obviously, the impact on the New Zealand dollar has been fairly strong, and longer-term swap rates here have gone up a bit today as well. In terms of that New Zealand dollar, I think down to around 78 US cents ish. Where do you see that tracking over the next few months? Yeah,
I guess in terms of a medium-term view on the New Zealand-US rate, and I think it's very important to differentiate when you talk about the New Zealand dollar what rates you're talking about now. So certainly our view is on New Zealand-US rate, because of generally a stronger US dollar in global foreign exchange markets, we're going to spend some time in the 70s now. The question, does it do we get to the low 70s or not? I'm not so sure about that, but certainly in the high 70s because of a stronger US dollar, and what's happened in Australia, which was of no surprise to us. I mean, the Aussie dollar was way overvalued and it needed a major correction, and it's now having that. And 80% of the time, the Kiwi US rate follows the Aussie. So the most important thing when you're talking about the New Zealand US rate is probably what's going on in Australia. Second is what's happening to the US dollar globally. And certainly our view is the US dollar is now strengthening again. It's on a strengthening path against all currencies, having weakened from 2003 to 2011. The US dollar, it's a big sea change in global currency markets. The US dollar now, it's not a smooth path. The US dollar generally is strengthening, and we see that the US dollar index continue to strengthen. So that should hold the Kiwi US rate below 80, but the other cross rates up. And the other cross rates up because we see the New Zealand dollar is probably going to outperform other currencies against compared against the US, because all currencies are quoted against the US. And why would we outperform? Well, eventually our interest rates are going to go up, and our economy is doing pretty good despite today's GDP figure. Our growth outlook and our economic health is pretty damn good. So we see Kiwi dollar outperforming other currencies, and all cross rates up. And you look at the Aussie Kiwi cross in the last few weeks. I mean, that's now at 85, and that's no great surprise either.
And in terms of the GDP figure today, I mean, 0.3%, did that surprise you?
It did, yeah. We thought agricultural production would have been up because of the drought and the livestock going to the works early. They clearly count the numbers a bit different to what we thought. We thought there could have been a number above 1%, actually, on top of the 1.5% we had in the December quarter. And that was largely based on that ANZ Bank Regional Growth Survey, which again was strong. But the official GDP numbers, it's 0.3. So, we thought the Kiwi could actually short-term go up on a stronger than expected GDP number today, and in fact we've got the opposite. But we should look ahead maybe than look back. But I was surprised at that number. And
looking ahead, your outlook for GDP is still fairly strong.
Yeah,
is it?
Well, 3% per annum is what the New Zealand economy did last year, and we think that's what it'll do this year and next year. So it's pretty impressive actually, and that's obviously clearly all the domestic economic numbers have been strong in recent months. The dollar coming back a bit is good for the export sector. If it stays in the 70s, they're competitive and can make money, make profits at those levels. It's hard to find any negatives, to be quite frank. Even the government's finances are coming back into order, so it's all pretty good.
Now, moving on to the Reserve Bank,
Yeah.
Graham Wheeler's the focus of much attention all the time,
Yep.
which comes with the territory. The official cash rate is still at 2.5%. He's obviously had the twin dilemmas of the high
Yep.
currency and the hot housing market, especially in Auckland, but now it's spreading elsewhere around the country too. Where do you see, what's your outlook for the OCR at the moment?
Well, I don't think he will raise it until next year, I mean March, April, May time. The risk is, and this is a risk he's prepared to take at the moment, the risk is that, housing market and inflation turn out to be higher than what they think. And when he does start to raise the OCR next year, 2014, he has to raise it quicker and in bigger jumps than what many might expect. So I think right now he's playing the game of buying time, and these macro-prudential tools that he's using, which is really just trying to constrain bank credit growth and just keeping a bit of a lid on the strong housing market. To me, they're around the edges, but to me they're buying time so he doesn't have to raise rates right now, because he knows if he raises interest rates now or in the next couple of months, it's just going to push the Kiwi dollar back up because no one else in the world is raising rates. So we'll stand out, Kiwi dollar goes up, and our export growth and our export competitiveness and profits and investment and jobs and everything else doesn't happen. So he's, as always, they walk the tightrope. But I think he's doing the right thing at the moment. I've been impressed with Wheeler. I think he's doing the right thing, and buying time at the moment is probably the smart way to go. You could say, if we got down to 74 or 73 in the Kiwi-US exchange rate, would then that give him room to raise rates if the housing market data was still strong and all the data was still strong in 3 or 4 months' time? Yeah, I could see that scenario. But anyone as a borrower, if you're not fixed already, you should be. Because clearly, I think the two risks, both the short end, the OCR going up, and that's only timing and speed, and then the long end is driven by the US 10-year Treasury bonds, and they're already going up and will go higher. So the risks are there. It comes down to timing, as always, but certainly for borrowers, that's what the risks are there.
And in terms of those macro-prudential tools, there's obviously a lot of talk about the loan-to-value ratio restriction, and the banks have been doing a lot of this high LVR lending, around 30% of overall growth, and Wheeler and his other staff at the Reserve Bank have expressed concern about that. Do you see them actually using this tool?
Yeah, I mean, I've always said that, the cracking the stick should do the job to bring the banks in line without actually doing it and regulating, or draconian regulation on the banks. So that's probably what he's hoping for. But then for credibility, if the banks don't come into line, they will have to actually do it, because if you threaten it, then don't do it, you lose credibility. I certainly, in terms of constraining bank credit growth and aggressiveness of lending, or cavalier lending, whatever you want to call it, and just increasing the capital requirements on the banks for certain types of loans is the way I would go. I think that gives the price mechanism and the signal through better than actually being draconian and saying, well, you can't lend above 80%.
And in terms of the official cash rate, I mean, if he starts to increase the official cash rate, in terms of impacting on the housing market, how much does he need to lift it by? Because if it's just 25 basis points, it's probably not going to. No.
So it depends, how strong the economy is and how inflation's tracking, early next year. But it could be at 50-point jumps, and the real risk, like Alan Bollard found out in 06-07, you can be raising the OCR really aggressively and it has no impact, because everyone's fixed their mortgage, and that might be the same situation again. So he might be raising the interest rates and actually not having too much impact on the housing market, because people are not silly. They'll be, I can't remember exactly off the top of my head what the proportion fixed and floating is now.
It's about 50-50.
Yeah, I would imagine over coming months that would be increasing, and therefore, a lot of people have said, oh well, because that's much lower and there's a lot more people on floating rate, it'll be more effective when the Reserve Bank do raise their rates. But he's given people time to fix, and I think that's what will happen. And we'll see that whether people are fixing to higher, more people are fixing in the mortgages. We'll see that through the swaps market. So the banks have got to offlay, when their clients fix, they've got to offlay their risk through the swaps market. So if we see 2, 3 and 4 year swap rates moving up over coming months, which I think we will, that's telling you that more and more people are fixing, because there'll be one-sided demand in the swaps market.
Well, thanks for that, Roger.
Pleasure.
That's Roger J. Kerr, who's a partner at PwC, and I'm Gareth Vaughan at interest.co.nz.